$1 million in tax-free wealth, gone. Not from a bad stock pick, not from a market crash. Not even from doing a Roth conversion wrong. And that's the part that should stop you cold, because the person who lost it did everything correctly. Hit the right bracket, paid the tax, followed every rule in the playbook. And still, one single decision quietly stripped over $1 million in compounding gains they will never get back. That decision wasn't complicated. It didn't require a law degree or a Bloomberg terminal. It required knowing when to start. That's it. When to start. And today I'm going to show you exactly what that timing mistake looks like, why it's almost universally misunderstood, and why the conventional wisdom you've been reading about Roth conversions is quietly destroying the wealth of the people who are following it most carefully. Here's what this video is actually about. Not a generic Roth conversion explainer, you've seen 100 of those. This is specifically about the timing trap inside the strategy. The trap that targets the most careful, the most disciplined, the most spreadsheet-obsessed planners among you. Because those are exactly the people most likely to fall into it. The more research you've done, the more likely you are to be confidently wrong. I'm going to walk you through what the trap is, why it works the way it does, why the so-called golden window you've been told to wait for might actually be the mechanism of your own financial damage, and how to calculate whether you're already inside the trap right now. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data link in the description. I want you to picture a greenhouse, not a fancy one. A basic glass structure where plants grow faster, bigger, and with zero interference from outside weather. Inside the greenhouse, everything compounds undisturbed. Outside the greenhouse, the weather is cold, unpredictable, and there's a guy standing at the fence who takes a percentage of your harvest every single year. That guy is the IRS. Your Roth IRA is the greenhouse. Your traditional IRA or 401k is the field outside, in the weather, with the harvest guy waiting patiently. He has incredible patience. He is not going anywhere. Now here's the thing most people do not understand about this greenhouse. It doesn't matter how big it is. It doesn't matter how efficiently you built it or how well designed the ventilation is. What determines your total harvest is one thing only: how long your plants spend inside it. Every year, a dollar sits outside, growing in that taxable field. The harvest guy clips his percentage. Every year, a dollar grows inside the greenhouse. The harvest guy gets nothing. Zero. The math is brutally simple. So the move seems obvious. Get your plants inside the greenhouse as fast as possible. Maximize the time inside, minimize the time outside. But here's what almost everyone does. They build the greenhouse, they look at it approvingly, they read 3 articles about Roth conversion brackets, and then they say, I'll start moving the plants in when I retire. And that sentence, that specific, reasonable sounding, financially literate sentence is where the $1 million disappears. Every time. And it's been disappearing for decades, while the financial planning industry talks exclusively about which door to walk through instead of how early to walk through it. In a few minutes, I'm going to show you the math on a specific scenario where 2 people with identical incomes, identical portfolio sizes, and identical tax bracket strategies end up with a lifetime wealth gap of over $2 million from a 5-year timing difference alone. But first, I need to explain why the conventional wisdom has a structural flaw that almost nobody addresses directly. The conventional Roth conversion advice goes like this. Wait until you retire. Your income drops, your tax bracket drops. You can now convert at 12%, maybe 15%. You move money into the Roth at low rates. The money grows tax-free forever. Simple, elegant, logical, and it's right as far as it goes. The problem is it doesn't go far enough. The conventional advice focuses almost entirely on the rate at which you convert which bracket, what percentage. It gives almost no attention to the length of time your money spends growing inside the Roth after the conversion happens. And that growth period, the runway, is where nearly all the actual value is created. The bracket is a one-time variable. The runway is a multi-decade multiplier. And almost all the articles, almost all the YouTube videos, almost all the advisor conversations optimize the one-time variable while quietly minimizing the multi-decade multiplier. There's a parable, I think, about whenever this comes up. There was a farmer named Edward who had 2 fields. One field was taxed heavily every harvest season. The other field was completely tax-free. Whatever grew there, he kept entirely. He knew he should move his crops to the tax-free field. He'd been intending to for years. He even told people at dinner parties that he was planning to do it. But every spring, he'd look at the situation and say, I'll move them next year, when conditions are better, when my income is lower, when the timing makes more sense. He waited 8 years. When he finally moved the crops to the tax-free field, they grew beautifully, no question. But the math on those 8 years of compounded growth sitting in the taxable field, taxed at 30% every single harvest, versus what 8 years inside the tax-free field would have produced, the gap was enormous. Edward didn't just pay more taxes than he needed to. He permanently and irreversibly reduced his total lifetime harvest. And here's the part that makes this psychologically brutal. No spreadsheet in year 9 would ever show him what year 1 could have been. You can only see what you have. You can never see what you would have had. That invisible loss is the entire trap. Stay with me, because this next part changes everything. People think the bracket is the problem. That's what every article, every Reddit thread, every well-meaning financial influencer focuses on. What bracket should I convert in? 12% versus 22 versus 24. There's endless debate about this. And yes, the bracket matters. I'm not dismissing it. But here's the reversal that almost nobody says out loud. You think the bracket is the problem, but the real problem is the runway. The bracket is a one-time decision you make when you execute the conversion. The runway lasts for the rest of your life. Optimizing the one-time decision at the expense of the multi-decade runway is exactly how you lose $1 million while feeling financially sophisticated about it. This is the Dunning-Kruger zone of retirement planning. You know enough to feel confident, but the knowledge you have describes the second most important variable, while the most important one sits quietly unaddressed. Let me be specific about the numbers here, because specificity is the only thing that makes this real. Let's say you're 55 years old. You have $800,000 in a traditional IRA. You plan to retire at 62. The golden window, that period between retirement and required minimum distributions, which under current law kick in at age 73, gives you roughly 11 years of lower income Roth conversion opportunity. In that window, with no job income, you might be able to convert at 12 or 15%. Sounds genuinely appealing. 11 years of converting at low rates. That's a real benefit. But here's what gets left out of that calculation. From 55 to 62, while you're still working, you might also have a conversion window, not at 12%, probably at 22 or 24, but you also have something that disappears the moment you retire. Excess cash flow, money from your salary that you're not spending. And that excess cash flow is actually the second most important factor in the entire Roth conversion equation, right behind timing. Because when you use outside cash to pay the taxes on a conversion, the full converted amount lands in the Roth. When you pay the taxes from inside the IRA, you're converting less than you think, and you're reducing the total amount of money that will ever grow tax-free. Here's the math on that. You do a $100,000 Roth conversion. Your effective tax on that conversion is $25,000. Scenario 1, you pay that tax from the IRA itself. The IRS takes $25,000 and $75,000 lands in your Roth. Scenario 2, you pay that $25,000 from a savings account. The full $100,000 lands in your Roth. Over 30 years at 7% annual returns, the difference between $75,000 and $100,000 inside a Roth, where the government never touches the growth, is approximately $197,000. That's not a rounding error. That's a real specific number on a single $100,000 conversion. Imagine that across 10 years of conversions. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. I want to introduce someone. His name is Marcus. I'll come back to him throughout this video because Marcus represents the type of situation I've seen play out in different variations more times than I'd like. Marcus is disciplined. He reads everything. He has a spreadsheet for his spreadsheet, literally. A master tracker with tabs for each tax year. He retired at 63 with about $1.4 million in a traditional 401k. He knew about Roth conversions long before he retired. He'd been researching them for years. He waited, very deliberately, for his golden window. And when it opened, he converted aggressively, hit the 12% bracket, used outside cash to pay the taxes, ran it by 2 different advisors. By the textbook, he executed perfectly. The problem with Marcus is what happened between ages 58 and 63. Nothing. He was earning well above what he was spending. He had meaningful excess cash flow every year. He could have been converting at 24% using that outside cash to pay the taxes, putting the full converted amount into the Roth and giving that money 5 additional years inside the greenhouse before retirement even began. He didn't, because every article he read said to wait for the golden window. His golden window. His big, beautiful, strategically optimal, perfectly timed golden window. Turned out to be a cage he built for himself out of good research. Now, this is where it gets really interesting. Let me give you the actual scenario analysis, because I want you to see what this looks like in real projected numbers, not hypothetical math on a whiteboard. 2 people. Let's call them Phil and Claire, both 60 years old, both still working. Phil earns $120,000 a year. Claire earns $120,000 combined income, $240,000 a year. They have about $700,000 each in their 401ks, so $1.4 million total in tax-deferred accounts. They own their home outright. They spend about $96,000 a year, $8,000 a month, which means on their $240,000 combined income, they have significant surplus cash flow after taxes and spending. They plan to retire at 65. Both will claim Social Security at 70 because waiting until 70 maximizes their lifetime benefit. Their golden window runs from 65 to 73, 8 years of lower income conversion opportunity before required minimum distributions begin. The question, should they wait until 65 to start converting, or should they start now at 60? While they're working, their combined income puts them squarely in the 22 and 24% brackets. Converting on top of that income means converting at 24% or even touching the 32. That sounds worse than 12 or 15 after retirement. On the surface, that is a rational reason to wait. But now run the full analysis. If they convert at 60, at 24%, using their surplus cash flow to pay the taxes money they would otherwise invest in a taxable brokerage account, the full converted amount goes into the Roth. And every dollar they convert at age 60 has 13 years of tax-free compounding before RMDs begin at 73. Compare that to a dollar converted at 65, which has 8 years. At 7% annual returns, the difference between 13 years and 8 years of compounding is a factor of about 1.4, meaning the same dollar converted 5 years earlier produces 40% more tax-free wealth by the time RMDs arrive. On a large enough conversion volume, that 40% difference accumulates into 7 figures. The software analysis on this specific Phil and Claire scenario, using professional financial planning tools, shows that beginning conversions at 60 while still working at the 24% bracket with outside cash covering the taxes produces a tax-adjusted lifetime benefit that runs over $2 million better than waiting until 65 to convert at 12%. $2 million from the same portfolio, from the same bracket strategy, from a 5-year timing difference, and choosing the right pile of money to pay the taxes. And the greenhouse was open the whole time. The plants were ready. Nobody told them to start moving. Here's something that connects to this that doesn't get enough attention. When Phil and Claire retire at 65 and their income drops, something else starts competing for that low bracket space. Social Security. When you start taking Social Security income, up to 85% of it is potentially taxable depending on your combined income. Add in required minimum distributions from a $1.4 million IRA, which by age 73, after 13 years of 7% growth, is going to be substantially larger. And that golden window fills up faster than people expect. Your 12% bracket space in retirement isn't as wide as it looks when you're 55 and imagining what retirement will feel like. The window has more guests than you planned for. And every dollar you didn't convert before retirement is a dollar the IRS gets to schedule into your retirement income, whether you want it there or not. This is the domino effect that advisors don't model for you in the first conversation. Large traditional IRA becomes large. RMD becomes higher. Social Security taxation becomes ARMA. Surcharges on Medicare becomes higher marginal rates in the years you thought would be your lowest. The whole thing cascades. And it's not some obscure tax trap. It's the completely predictable outcome of deferring too long. The IRS built the RMD schedule knowing exactly how this math works. They've been playing this game much longer than any of us. The IRS is not rooting against you. They're just patiently invested in your traditional IRA alongside you. They own their percentage. They're going to collect it. The only question is when, and at what rate, and whether you get any say in the matter. There are actually 3 levels to understanding the Roth conversion decision. And knowing which level you're operating at determines how much money you keep. Level 1 is knowing that Roth conversions exist and that tax-free growth is better than taxable growth. Most people who've done any retirement reading are here. They know the concept. They've probably opened a Roth account. Good start. Level 2 is optimizing the bracket. 12% versus 22, fill the bracket, don't cross into the next tier, time the conversion around retirement income, watch the IRMAA thresholds. A lot of people who've done serious research are at level 2. They feel competent here, and they are at this level. The conversations with advisors, the articles, the YouTube videos, the Reddit threads, most of them operate at level 2. Level 3 is optimizing the runway. Understanding that the bracket optimization is a secondary consideration to the compounding window, and that the compounding window opens the moment a dollar enters the Roth, not the moment you stop working. It starts right now, if you convert right now, and every year you wait, the window shrinks. Level 3 also includes understanding how to source the tax payment. Outside cash means full amount in. Inside IRA, money means reduced effectiveness. Level 3 players are not the loudest voices in any financial planning conversation. They tend to be the ones who've already run the 30-year projections and stopped arguing about tax brackets. Almost nobody is operating at level 3. The advisors charging the most to help you are frequently still optimizing at level 2. That's not an insult. Level 2 is genuinely complex, and most people never get there. But if you're watching a detailed tax strategy video, and you've been researching this for years, level 2 is probably where you live. And the gap between level 2 and level 3 is where the $1 million went. This is basically the IRS saying, take your time, I'll be here. Growing your balance, taking my percentage when you're ready. The IRS has extremely patient incentives. You should have impatient ones. Let me bring Marcus back, because his story has a second chapter. Marcus, now at 67, finally sat down with someone who ran the complete analysis, not just bracket optimization, but the full timeline, 30-year projection, tax-free compounding inside the Roth modeled against taxable compounding in the traditional IRA. RMD impact on Social Security taxation modeled year by year. Medicare RMAA surcharges modeled at each income tier. Everything stacked together the way it actually stacks in real retirement. The number that came back was $1.2 million. That was the estimated gap between his actual projected lifetime wealth and what it would have been if he had started converting at 58 instead of 63. $1.2 million in lifetime tax-free wealth, gone. Not as a paper loss, as a physical reduction in the total amount of money that will ever exist in his Roth. Because those 5 years of compounding inside the greenhouse at 7% cannot be retroactively added. They happened. Outside, in the taxable field. And the harvest guy took his cut every year. Marcus did everything right. According to the playbook, he executed correctly. He just executed the incomplete version of the playbook with complete confidence. That's the cruelest version of a financial mistake. Not ignorance, but incomplete knowledge dressed up as expertise. There's one more thing I want to add here, and it's the layer that makes this genuinely absurd when you step back and look at it from a systems perspective. The people who are most likely to fall into the timing trap are not careless people. They're careful people. Careful people read the articles. Careful people follow the conventional wisdom. Careful people wait for the golden window because that's what the conventional wisdom says to do. And careful people follow conventional wisdom. The system, the combination of incomplete financial media, advisor incentive structures, And the natural human preference for deferring pain is almost perfectly designed to capture the most responsible participants. If you've spent years doing your homework on Roth conversions and you're still waiting to start, there is a real possibility the homework itself pointed you in a slightly wrong direction. Let me get concrete with a realistic scenario you can actually map yourself onto. You're 45, married. You and your spouse earn a combined income of $190,000 a year. You have $400,000 in a traditional 401k. You're spending about $100,000 annually and saving the rest after taxes. Call it $60,000 a year, sitting in a combination of savings and taxable brokerage. Your marginal bracket is 24%. Option A. You wait until you retire at 62. Income drops. You convert at 12 to 15% for about 10 years before RMDs hit at 73. You feel smart about your 12% rate. You tell people at dinner parties about your golden window strategy. Option B. You start converting now at 45. You're in the 24% bracket, but you redirect that $60,000 a year of surplus savings instead of putting it into a taxable brokerage account toward paying the taxes on your Roth conversions. So you convert approximately $100,000 a year, pay the $24,000 in taxes from outside savings, and the full $100,000 lands in the Roth. Here's the comparison. Under option A, your converted money has roughly 10 years of Roth compounding before RMDs begin at 73. Under option B, starting at 45, you get 28 years of Roth compounding before the same age. At 7% annual returns, money grows by a factor of approximately 6 over 28 years. Over 10 years, the same money grows by a factor of about 2. That's 3 times the multiplier. On a $400,000 converted balance, the difference between a factor of 6 and a factor of 2 is over $1.6 million in the Roth alone, before accounting for the ongoing conversions you do in subsequent years. Yes, you paid more per dollar, converted in option B. 24% instead of roughly 14%. On $100,000 converted, that's about $10,000 more in taxes in the short term. But you're getting 28 years of tax-free compounding instead of 10. That $10,000 additional tax cost generates $1 million+ difference in outcome. That is not a trade-off. That is one of the clearest arbitrage opportunities in the entire tax code. The government priced the conversion tax, assuming most people would wait. It didn't fully price in what happens when you start early and run the full compounding window. And the taxes you pay in option B come from money that was going to be taxed anyway. Savings sitting in a taxable brokerage were going to generate taxable dividends and capital gains every year they sat there. By redirecting that money to cover conversion taxes instead, you're not spending, you're reallocating from a taxable future to a tax-free one. The greenhouse was open. The money was sitting outside getting rained on. And somehow the plan was to wait. All right, here's where I land on all of this. $1 million in tax-free wealth, gone. Not from a bad investment, not from ignoring Roth conversions. From following the incomplete version of the strategy with complete confidence at the wrong level of the problem, while fully believing the approach was correct. 3 things, specific things, not generic things. First, stop optimizing the bracket before you've optimized the runway. Run a scenario where you start converting now at whatever bracket you're in against a scenario where you wait for your golden window. Get an actual dollar number on the gap, not a rough estimate. The specific projected difference in lifetime tax-free wealth. That number will be larger than you expect, and it's the only thing that will override the emotional comfort of waiting. Second, find your outside cash. If you have money in a taxable brokerage or high-yield savings that isn't committed to a specific purchase, that money is a Roth conversion tax engine that's currently sitting idle. Using it to pay conversion taxes instead of drawing from the IRA is the difference between $75,000 and $100,000 inside the Roth on every single conversion. Across years of converting, this is not a minor detail, it's a structural advantage that compounds. Third, adjust your timeline by 5 years and model what happens. Whatever age you plan to start converting, model what happens if you start 5 years earlier. If you plan to start at retirement, model starting 5 years before retirement. If you plan to start at 65, Model 60. The specific number that comes back is usually jarring enough to change the decision. Marcus didn't have that number until he was 67, and the damage was largely done. You can get it right now. The greenhouse has been sitting there. It was open the entire time. The question was never whether to use it. The question was always when. And every year the answer was later. A little more of the harvest stayed outside in the rain, getting taxed, while the inside of the greenhouse sat empty and waiting. Lazy investing built more fortune than crypto memes. And patient tax planning built more wealth than Roth conversions done 5 years too late. The IRS wrote the entire schedule counting on your patience. Try disappointing them.